Good afternoon. This is Matthew Lindsay with Precision Home Group here in Anchorage, Alaska. We are coming to you today to talk to you about analyzing the deal, talking about commercial real estate all week long. That's what we've been doing. It's been all building up, leading up to today. Today, we are analyzing a local deal here in Anchorage, Alaska. So, I want to recap some of the things that we've been talking about before we jump in, before we start analyzing this deal. So what we've been talking about first is we talked about the time value of money, how to have positive leverage, how to utilize real estate as an investment tool, as an investment vehicle to gain more leverage, right? So we talked about that. We also talked about cap rate as a valuation tool, as a relationship and a ratio, not just a rate of return. It's much more than that, and it is not a rate of return. Talk about the differences with that in terms of financing versus paying all cash and cash on cash returns and stuff like that. We also talked about key terms. That was yesterday. We went over a bunch of those key terms. We did that because today we're going to be using a lot of those key terms. So I'll reference some of those key terms we went over, and I will go back over them to review them, let you know what they are again as we start to utilize them. So today what we're doing is we have a local deal here in Anchorage, Alaska. You can see here Cope Street. So this deal is a 35-unit multifamily commercial deal here in Anchorage. We're just going to break it down on a basic level, and we're just going to be doing it for the purchase. Now, when we do this for a purchase for a client, we're also going to be looking at future cash flows and a future sale, right? Because we want to know our exit strategy before we get into the building. That way we know how to invest, what to pay for, and what our goals are for that building. Real estate is a long-term hold. We see a lot of people these days doing the flips, doing the wholesale and things like that. That is more, in my opinion, that's more of a sales position instead of a true real estate investment. You're not necessarily getting the cash flow out of that. You're doing that for appreciation, for that lump sum at the end of the day, a quick turn and burn. It's not building that cash flow up over time. So that is one way to invest, but we are really focusing on multifamily and holding it for the long term. That's where you're gonna make the money, right? So let's jump into this. So this building here is located kind of midtown area of Anchorage. What we have here is 3938 Cope Street. Like I said, it's a 35-unit building, multifamily, and it's listed at $4,350,000. So $4.35 million is the list price for this. We said it was 35 units. Those 35 units are broken up into 6 one-bedrooms, 27 two-bedrooms, and we also have 2 three-bedrooms. So that is the general idea of this building. Now, one thing to keep in mind when you're looking at these buildings is that you want to look at the finances, right? But not all agents out there are trained the same, know the same knowledge, or display the knowledge the same way, right? So I'm referring to finances here. A lot of people keep their books differently. A lot of people don't necessarily keep the same books. So somebody's expenses over here might look different over here. A building owner might run his building as a business. Someone might run it as a tax shelter for their personal finances. They can run things through that. They might have more expenses, while these people may not. So you have all these differences. So before you get into analyzing a deal, what you want to make sure is that you are actually looking at really good, solid numbers. Make sure that you're getting at least 3 years backdated taxes. Make sure you're looking at everything and that you're looking at a pattern and a history of the books in that building. You don't want just the last years, because those could be fluffed up. They could be filling that building to sell it, and now you got a lot of tenants who aren't necessarily screened, or tenants that you want in the building, right? They may be willing to pay above market prices because they can't find a unit, a apartment anywhere else in town, but now they can. So make sure that when you're going in there, do your due diligence. Make sure that you're going in there and pulling all the finances that you can, get all the information. So just a little FYI for you. So what we're going to do is we're going to look at this And we're going to assume a couple things. So take that into mind. When you assume things, you need to make sure and double check, confirm, and look at all the correct information like I'm talking about. So for some of the assumptions today is going to be on the loan type that we are looking at to analyze this deal. It's a common loan type. It's going to be we're going to have a 20% down payment. Some of these interest rates and stuff like that, they will change. So talk to your local lender. If you are here in Anchorage, I'd love to talk to you, get you connected. If you're outside, also feel free to touch base with me. We can get you connected with people in your area as well. So we said we had a $4.35 million property. That is the list price. Just say that we're going to offer list price, okay? So with that being said, if we're going to put 20% down, then that's going to be a down payment of $870,000. That's just the down payment. Keep that in mind. We're going to talk about initial investment here in a little bit. So keep that 870 in mind. So with that 870 minus the 4.35, that gives us a loan of 3.48 million to finance, right? So that's going to be the finance portion. That's going to be the loan. So with that, some of those loan assumptions that I was talking about is we're going to go a 30-year term. We're going to also have that amortized. I always get that amortized. You know what I'm talking about, over 30 years. We're going to have an interest rate of 6.25%. And what that's going to give us is an annual debt service of $257,124. Now, I could do a whole video on how to figure out amortized loans, how to figure out what the principal, what the interest is, what those monthly payments are going to be, what the annual debt service is, and how to figure that out. We'll do that at a later time. But this is pretty simple. Feel free to reach out to me if you have questions on that, or any lender is going to be able to do that for you as well. So that's what we got. We have annual debt service is $257,124 with that loan. We're going to come back to that here once we start analyzing the deal, okay? So keep that in mind. So before I was talking about the initial investment and how that's different from the down payment. So the down payment is going to be $870,000. We talked about that up here. Now that's going to be different from our initial investment, and some people don't quite understand that. They think, oh, I just need my down payment and I'm good to go. That's incorrect, and here's why. Because there is going to be some closing costs, there's going to be some discount points, there's going to be things that you got to bring to the table that cost money in order to make this deal happen. So yes, you have your down payment, but there's going to be additional funds needed in order to make that loan happen. So for this loan, with the loan costs, with the discount points and everything else, our initial investment went from the $870,000 payment all the way up to $936,300. So that's our initial investment. So right off the bat, I know, hey, I have a $4.35 million property. I know that my down payment's $870, that my my initial investment is $936,300, and that my annual debt service is $257,124. So with these numbers, I can actually start looking at this property, start analyzing it. I do need a little bit more information, and I'm going to go digging for that. So once you get all that information dug up, the first couple things we're going to need to know is PRI. Now, this is a term that we talked about yesterday, and that stood for potential rental income. And what that is all 35 units filled at market rate 100% of the year, and that is going to give you your potential rental income. That is 100% occupancy at full price. So if we had that, that's a perfect world, and it never happens. And if it is, quick tip, your rates are probably, two things are happening. One, your rates are too low, which means that you can raise them because you want to see a little bit of vacancy. If you have a little bit of vacancy, you know that your rates are probably right on par. Or two, you just have an amazing building, best amenities, and you can't get any better than that. That's hard to find here in Anchorage. So potential rental income for this property is $468,000 per year. Another key thing, keep in mind, everything is annualized. Don't run these monthly. If you're running these monthly, you're doing it wrong, and you need to run everything annually so you can get accurate numbers. So you take your potential rental income, 468, minus the vacancy rate, another key term we talked about yesterday. And what that is that safe kind of discount rate, industry standard for the area at that time. So a lot of buildings in your area, usually it's going to be 16 plus units are going to be able to go, take a survey. They're going to go through, see how much of their building is vacant at any one time. It's kind of the standard industry average. And right now it's about 5%. It's a little bit higher than that, but we're using 5% for our numbers. So 5% of the potential rental income is $23,430. And then we also have miscellaneous income. This could be anything from, hey, you have community laundry services at your property. There's multiple other different income potentials. Maybe you have carports or garages that you charge extra money for per month. Maybe you have storage units that you charge extra income every month, right? I've seen some people put cell towers on the top of their buildings, and they actually get cash flow from that every month. People put advertisements on their building. They get cash flow from that for every month. So there's different ways to get that additional income per month. So right now we're looking at $7,900. So that gives us our gross rental income. So we take our PRI minus our vacancy plus our income. We have $453,090 is our gross rental. Now we got to look at our expenses, right? In order to get our NOI, right? So we're going to get to that here in a second. Right now, looking at the numbers, looking at everything, all the financials I was able to pull on this building, we have expenses of $116,053 per year. Now, what that's going to cover is, all the different utilities, the insurance. You're looking at maintenance on the building. You're looking at different things like legal, if you have any evictions, anything like that. You have management. We said maintenance, janitorial, grounds maintenance. Up here in Alaska, snow is a huge thing. Snow removal, lawn care, all these kinds of things for the building, anything you can expend to the building. The biggest thing to keep in mind is that this is not the place for debt service, okay? This is just building expenses. So NOI does not include debt service. We'll talk about that here in a second. So NOI, which is the net operating income, it's going to be the gross income minus your expenses. So our NOI for this building is going to be $337,037. That's our NOI for this building, net operating income. Now we're going to take out our annual debt service, which we already figured from our loan over here, right, with the loan assumptions that we took in place. So we figured that that's going to be $257,124 per year. So we're going to minus that from our NOI, our net operating income, and that gives us just shy of $80,000 per year. That's going to be $79,913 per year is going to be the cash flow on this building. Now you still have taxes and some other things to take out of this, but that's going to be first year cash flow. Now, a couple things we can do with this number. We can look at this and say, hey, let's divide that by our initial investment, not the down payment, right? But by the initial investment. That will give you a cash on cash return. And so what we're going to do is we're going to take the cash flow divided by our initial investment to see what return are we getting just on the investment we put into the property, right? Because at the end of the day, we just spent $936,000 on this building, right? We didn't spend $435 because someone else is going to pay that debt down. Someone else is going to pay this $3.48 million. Someone else, the tenants, are paying that down. The only investment that you have in there right now should be the $936,300. Now there's going to be some capital expenditures, but you should be putting cash flow away, putting money away for reserves for that kind of thing. So our cash on cash, just to recap, is going to take our cash flow after debt service, and we're going to subtract or divide that by our initial investment, gives us 8.5%. So you're getting 8.5% return on your initial investment for this first year. Now, this may change over time as you have pay down, as you have appreciation, as you can raise rents over times. You know, I've seen anywhere from people who don't raise rents at all, upwards to, you know, about 3% being raised per year is pretty average. So if you can raise that rent 3%, that cash flow is going to raise a little bit as well, right? So that's what we have there. Yesterday we talked about cap rate being a valuation tool, being a relationship between NOI and the value of a property. We talked about it not being a rate of return, right? So common cap rate in this area is going to be, you know, 7 to 8% in there. The building, the listing agent used 7.5% in order to get the value for this property. So what we're going to do is we're going to take the NOI, which is the $337,037, and we're going to divide that by 7.5%, and we're going to get a value of 4.493876. Where does that look familiar? That's right. That's the value, 4.35. That's where they got the value of this building. So that is breaking down the deal. This is a building listed at 4.35 million, 35 units here in Anchorage that produces $80,000 a year. Now, is this a good investment? That's a great question that I get a lot of the time. And my answer is, it depends. What are you investing for? What is your investment style? Are you going to sit there and hold over the long term? Are you going to go in? Are you going to try to raise the rent? Are you trying to raise the value by going in and doing some fixes? There's strategies for that. Is this a long-term hold, something you want to trade in the short term? What is your style? And that really is the question here, is what is your style and how can this building help you or hinder you? And it's a case-by-case scenario that we just got to sit down and look at your bigger goals and figure out, does this building here fit into your goals? And if it does, then great. Let's sit down. Let's talk about that. Let's get you in front of some lenders. If not, then hey, let's look at other buildings. Let's analyze other deals. And you got to do that. At the end of the day, if you're not sitting and analyzing every deal you possibly can, you're not going to know a good deal from a bad deal. And at the end of the day, your investments are going to suffer because of that. What the biggest thing that I see is people jumping into investments just because they want to become an investor. They want a name, a title, and that is when people suffer. So know your deal, analyze your deal. If you need help, I would love to talk to you. I have tons and tons of resources here I'd love to share with you. So reach out to me. Give me a call at 907-302-1011. Send me a direct message, a comment, a link. Thank you for sharing. Thank you for liking and showing up today. I appreciate it.